Welcome back to Live from Paris. It's time now for today's business news, and our editor, Owen Fairclough, is here. And we're also glad to welcome our guest, Ludovic Soubrun, to the show. Ludovic is the chief economist for the French credit insurance company, and we'll be picking your brains in just a moment on this Eurozone crisis. So hope you've got your thinking cap on there. But Owen, first of all, you've got the opening numbers on the European markets.
It's all looking pretty horrific this morning, Lorna, on the European markets, extending that sell-off that we've seen for at least the past couple of weeks now, where Spain's IBEX opening down 1.2%. The DAX as well, one of the better performing European markets this year, also off by around 1%. Those are the numbers there for you, where you've got Spanish borrowing costs now up to 6.5%, creeping back up to that danger zone level of 7% on 10-year bond yields. Remember, that is pretty much the place where other European economies like Ireland and Greece had to raise the white flag and ask for bailouts. On the Asian markets, a similar story, a huge sell-off on the Hang Seng as well, around 3.5% down. And it's also worth mentioning that the euro is down to another low against the dollar this Wednesday morning, down to $1.27. That is a 4-month low, not quite as low as it was at the height of the financial crisis, but we haven't seen the euro trading against the dollar quite so low for the past 12 months.
Okay.
We can turn now to Ludovic, who I forgot to put on Lorna's script. I'm sorry. Is from Euler Hermes, the chief economist for the French credit insurance company Euler Hermes. Ludovic, given those market numbers we've just seen, where is this market going? This has all the hallmarks of 12 months ago. I find myself sitting here thinking I'm back in 2011.
Well, we ever left 2011. I think we are still in the twilight zone, and we've been in the twilight zone for quite some time right now. The question is, as you said, there are new things happening. The euro-dollar exchange rate is something that is pretty new in terms of what we've seen in the last month, because each time there was a new agreement in Greece that I know that we're going to talk about, the euro-dollar exchange rate was actually going the other way around. So I think now it's a little bit the new thing in the last news that we've heard, but the stocks markets have been quite... I think the idea is that it's been quite a story of noise to signal ratio, and that we don't really know what is the real story underneath. And there is a lot of volatility, of course, but especially in the last month, we've seen a lot of downwards volatility, which is really not 2011 yet, but certainly close to.
I'm glad you mentioned noise, because you're right. There is all this political posturing. We get these messages from these Eurozone leaders, some now talking openly, particularly at the European Central Bank. You wouldn't have imagined ECB officials a year ago publicly sort of modelling a Greek exit. If you set aside all that at the moment, though, one thing that is undeniable is we're seeing capital flight from Greece. I think around 700 million euros withdrawn from Greek banks alone on Monday. Isn't that a sure and concrete sign of a country that is about to default, or is certainly going to suffer some sort of mass economic trauma, when people have no confidence in the banking system and are pulling money out at almost record amounts?
Well, I think what is sure is that the time that has spent between the first, July 21st agreement, 2011, and now is certainly, time for contingency planning from banks, but also from companies. And I think it will be foolish to think that nobody has been preparing for such an orderly default of Greece. The idea now is that, I think mentality is changing around the very issue of an exit of Greece, which is, what is efficient? What is the mutual efficiency that we can find, even for countries like France and Germany, but also for Greece, for an orderly exit. I think that the problem right now that there is no solution for Greece standalone. I mean, should they reintroduce and redenominate with the drachma, they have no exports. So we don't really know what the future could be. What we know that at the border of Europe, you will have a really, really troubled country with a deep recession. So maybe it could serve as a demonstration effect from Italy and Spain. But more importantly, I think the idea is that we won't be able to let Greece go like this, because they will be at the border of Europe. So they will need to have some support from the international organizations, but also from the Eurozone. So it's really hard to know right now, should they leave, should they go? At Euler Hermes, we forecast the likelihood of an early exit above 50% now, which is, we've increased this by 10 percentage points over the last month or so. The results of the election are, of course, worrying to us, because we think that the fact that even a very technocratic government hasn't actually made it to the end of the coalition is just a new evidence towards the fact that we don't know how the Greeks want to run the country in the near future. What we know that the Greeks themselves don't want to leave the Eurozone. But the phrasing around this is extremely awkward, because the question is not about leaving or staying in the Eurozone, it's about austerity, because they will need to cut further down the road, and they haven't agreed on that point yet.
Okay, and just briefly to finish off then, let's turn to the meeting between François Hollande and Angela Merkel. A key meeting, of course. Have they found some common ground on how to run the economy in Europe?
Well, I was not in the meeting. I would have loved to, but apparently, exactly, a little economic mouse in the meeting. The question is, of course, I think it was a touching base kind of meeting. I'm sure that President Hollande actually told Angela another time, Chancellor Merkel another time, what his projects were, the project bonds, the European Investment Bank. But I think the real question now is to go beyond semantics and beyond the austerity versus growth type of discussion, which is not really the right one. The real discussion is what we want to do on the monetary policy stance, with banks included, and what we want to do on the fiscal space issue. Because, of course, I think nobody agrees that the last treaty or the last renegotiated treaty is something that is feasible, even for Germany. So what kind of target should we set on the one hand, and what type of new innovative solution we want to find for a fiscal Europe with transfers allowed, and for a monetary Europe that is actually consistent in terms of economic policy.
Okay, Ludovic, thank you very much indeed for joining us here on France 24. That's just about it for today. Thank you very much indeed, Owen, as well, for being with us. And we're going to leave you now with some pictures from The Hague. Go back to that war crimes trial of Ratko Mladic, which is getting underway over in The Hague right now. Thanks for joining us.